Ever wanted to amplify your stock market gains but didn't have enough funds? Margin Trading Facility, or MTF, might be your answer. Today, we'll simplify everything you need to know about MTF, what it is, how it works, and the do's and don'ts to succeed. Stay tuned till the end for tips to minimize risks while using MTF. First, let us understand, what is MTF? MTF allows traders to buy stocks by borrowing money from their broker. Think of it like buying on credit, where you pay a margin, and the broker lends you the rest. Let's see it with an example. Let's say you want to buy 1 lakh worth of stocks but only have 25,000. With MTF, the broker funds the remaining 75,000, and you pay interest on this amount. Let's see it with the Rohan story, a beginner using MTF. Meet Rohan, a young investor who recently started trading. He discovered MTF and decided to use it to maximize his gains. Let's see a scenario before using MTF. Rohan had limited funds and missed out on opportunities to buy stocks during market dips. Now let's see the scenario after using MTF. With MTF, Rohan bought 1 lakh worth of shares in a growing company by investing just 25,000. He earned significant profits as the stock price rose, but he also learned the importance of managing risks. Now let us see how does MTF work. First, let's see who are eligible for this. You need to enable a margin trading account with a broker who offers MTF. Now let's see what is margin requirement. Deposit a percentage of the total trade value, known as the margin. For instance, in Rohan's case, he invested 1 lakh in a stock by contributing 25,000 from his own funds, while the remaining amount was financed by the broker. This 25,000 is referred to as the margin. Now let's learn about leverage. The broker lends you the remaining amount to complete the trade. For example, in the above case, Rohan invested 1 lakh in a stock with just 25,000, while the remaining 75,000 was contributed by the broker. This 75,000 provided by the broker is referred to as leverage. The amount of leverage provided by a broker depends on the specific stock. Some stocks may offer 4x leverage, while others may provide 5x leverage. For instance, if a stock offers 5x leverage, an investment of 1 lakh would require a margin of 20,000, with the remaining 80,000 being provided by the broker as leverage. Now let's learn about interest charges. You pay interest on the borrowed amount until you square off the position. The interest amount paid to brokers depends on their policies, typically ranging between 0.04% and 0.06% per day. For instance, in the above case, with leverage of 80,000, an interest rate of 0.04% would result in a daily interest of 32 until the trade is closed. Now let's see the duration of MTF trades. MTF trades can be held for as long as desired. However, it is important to consider the accumulating interest charges, which will apply for the duration of the trade. Now let's see the advantages of using MTF. Increased buying power. Amplify your investment potential and take advantage of market opportunities. Example, Rohan's 25,000 became 1 lakh in MTF trading power. Short-term gains, ideal for traders looking to profit from short-term price movements. For example, if you invest 1 lakh in a stock with 20,000 as margin and 80,000 as leverage, and the stock appreciates by 20% in the short term, you will earn a profit of 20,000. This effectively means a 100% return on the margin amount. Access to premium stocks. Invest in high-value stocks that may otherwise be out of your budget. For example, if a stock is priced at 1 lakh and you identify an opportunity to invest in it, but have only 20,000 in your account, you can utilize the margin trading facility to make the investment. Now let us see risks involved in MTF. Market volatility. Leverage can amplify both gains and losses. A small market dip could result in significant losses. Interest costs. High interest rates can eat into your profits. For example, if you invest 1 lakh in a stock and achieve a 10% return over a year, you would make a profit of 10,000, which translates to a 50% return on the margin amount of 20,000. However, if you utilize the margin trading facility, MTF, with 20,000 as margin and 80,000 as leverage at an interest rate of 0.04% per day, equivalent to 14.6% annually, the interest cost on the 80,000 leverage would amount to 11,680 for the year. This results in a net loss of 1,680, which translates to an 8.4% loss on the margin amount. Furthermore, this calculation excludes additional charges such as brokerage, securities transaction tax, and other fees. Including these costs would increase the overall loss further. Margin calls. If your stock value drops significantly, the broker may ask you to deposit more money to maintain your position. For example, if you buy a stock worth 100,000 and it declines by 2% the next day, a loss of 2,000 would need to be added to your account. Failing to cover this amount could result in the MTF trade being automatically squared off by broker. Now let us see some tips for using MTF wisely. Invest in quality stocks. Choose fundamentally strong stocks with low volatility. Example, blue chip companies. Monitor interest costs. Ensure the potential profit outweighs the cost of borrowing. For example, if you are holding a stock for up to 1 year using leverage, it is advisable to set a target return of at least 20%. This ensures that the profits outweigh the interest costs on the leverage, minimizing the risk of incurring a loss. Use MTF for short-term trades. Avoid holding leveraged positions for too long to minimize interest expenses. Stay informed. Keep an eye on market trends and news that might impact your trades. MTF can be a powerful tool to amplify your gains, but it comes with risks. Use it wisely, invest in quality stocks, and always keep an eye on your leverage and interest costs. If this video helped you understand MTF, give it a thumbs up, subscribe for more stock market insights, and comment below with your experiences or questions about MTF.